How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group, and today's topic I want to discuss with you part two of my Annuities for Dummies video series. And this is going to be specifically on immediate annuities. Immediate annuities are the most basic type of annuity. A lot of times people think that all annuities are immediate annuities. That's just simply not the case. Immediate annuities, I use it decent amount in my practice, but only for the correct situation. Because there's a lot of cons to immediate annuities that I really do not like. But I just want to go really into depth for the individual that might have came into contact with an immediate annuity, or you came across an advisor that's trying to sell you an immediate annuity, and just trying to figure out what exactly are the nuances. Why would this be enticing to buy one, or simply why is it not a fit? So with immediate annuities, what you're doing is you're taking dollars. Now, these monies could be either in cash accounts, like if you just sold a business or you received an inheritance or you just saved it up, under a mattress or in a savings account. You could take monies from that, or you could take it from a type of retirement account, such as an IRA account, a 401k account, something that might have been deemed specifically as a retirement account. So it's known as a qualified retirement account. So you could utilize an immediate annuity in these two separate avenues. Um, what happens, and the whole reason why you might want to do this, is you're taking these dollar amounts and you're purchasing a type of, I guess I'll make this a little circle, a type of contract through an insurance company. With all types of annuities, only insurance companies could offer annuities. That's why a lot of people say, oh, well, is it FDIC insured? And it's no, because FDIC insurance goes directly to banks. So just like a bank can offer bank CDs, an insurance company can't offer a CD. But an insurance company could offer annuity just like banks can't offer annuities. It goes by legal reserve structures and making sure that you have to have large organizations, and it has to be both in compliance on a state and federal basis in order to offer those specific contracts. So what happens is with an immediate annuity, an individual might say, "Oh, listen, I want to receive income. I saved up a bucket of money. Maybe this bucket is $100,000. I saved up a bucket of money. I have the option, let's say this person is 65 years old. They have the option to keep that money in that cash account, or keep that money in that IRA account, or in their 401k account, or whatever that is, and just slowly pull out this money. So they could just do very proper budgeting, but if this individual keeps living and living and living and living and living, and let's say they're taking out, five, $7,000, $10,000 a year, they're not sure how much to pull out. Well, then there's a risk associated there. There's a risk that if they keep living and they keep pulling out more and more money, and they didn't set it up properly, that individual is going to have no more money left. And then majority of the times, individuals are just subject to whatever Social Security is going to pay them, because they outlive their retirement dollars too quickly, or not even a retirement dollar, just any sort of income type stream or income type plan. So what an individual could do is say, okay, I want to have guarantees. I want to have some sort of safety net, some sort of confidence that I could take my money, purchase a contract that's going to pay me income for the rest of my life. Okay, so this is going to be a very basic type of single premium immediate annuity. What this person's doing is they're taking a lump sum of money, whether that's in the IRA account or in just regular cash account, and they're purchasing a single premium immediate annuity. So this contract is set up through the insurance company, and then the insurance company is going to have a specific set of terms that says, okay, if you're 60 years old and you're a male and you're giving us $100,000, we're going to be able to provide you $6,000 per year. So then maybe that might be company ABC. But then company XYZ says, okay, for that same $100,000, instead of giving you $6,000 every single year for the day you die, we understand our mortality tables a little bit better. We're going to give you $7,000 per year to the day that you die. So obviously you want to go with company XYZ over company ABC if it's a strong contract. If there's not funny business, if there's no funny games, happening with that. So that's just a very basic type of annuity. This is known as a single premium. This is a life-only option. Many times individuals do not do that anymore. It was originally set up for through insurance companies to be the complete opposite of life insurance. So with life insurance, someone would purchase a life insurance policy and pay monies into a life insurance policy to then have a large lump sum death benefit get paid directly to their beneficiaries whenever that person passes away. So life insurance protects a person from dying too soon. Annuities protect a person from living too long. So they would essentially take a lump sum, purchase a contract, and now you have smaller payments coming, to that individual, and that's going to be guaranteed for that person's rest of their life. So you have the life only option that would pay that annuitant for the rest of that person's life. Because we're utilizing the word immediate, or we're having an immediate annuity, this means that this payout is going to occur within the year. So some people like to have their contract set up where they want to start their income streams get paid out to them, immediately, meaning as quick as 30 days. Some people like to wait a couple of months, whatever their preference is. But understand, they could receive this income on a monthly basis, quarterly basis, semi-annual basis, or annual basis, and that would be coming to that annuitant for the rest of their life. Now, on the life only option, understand, what's that risk? Well, this is going to give them the highest income benefit, the highest income payment, because the risk is this individual, if he passes away too soon, the insurance company wins, meaning the insurance company now does not have to pay any more money to that person because obviously they passed away. So that individual that is purchasing this contract is having the peace of mind that they'll always have income coming to them for the rest of their life. The downside to it is if they pass away, in the earlier years, well then they're just subconsciously will know that, that they kind of lost out on the deal. What do I mean by that? Well, if you have $100,000 and let's say that this company, when they said, okay, listen, we're going to pay you $5,000 to the day that you pass away, and this person was 60 years old. Well, we understand 5,000 times 20 years would equal $100,000, right? So they say, okay, well, if I feel as if I'm going to live into my 90s or 95, whatever that is, this might be a decent deal. Now understand, annuities are going to be more, they're going to incentivize you to purchase one a little bit better than that, probably be, closer to that $6,000 mark, but just for hypothetical purposes, let's say that this person only lives for 10 years. Well, they understand that they would have gotten paid $50,000, 5,000 times 10 years, 50 grand, and let's say this person passes away at age 70, well, now the insurance company walks away with that $50,000 profit. And they were able to take that lump sum and leverage that on the back end to, produce higher rates of return for themselves, with all that lump sum cash. So with that aspect, the insurance company kept full control of that money. Now, let's say if you have a better contract, let's say maybe one that's paying $7,000 per year. And let's say this person keeps living, and then all of a sudden this individual dies off, at age 90. Well, they were getting paid $7,000 per year starting at age 60. They were living for 30 years. 7,000 times 30 years is $210,000. So rather than the first individual that says, okay, well, maybe I should just pull out $7,000 per year, well, this person would have outlived their money very quickly. This individual would have still been now leveraging the insurance company and their guarantee because the insurance company is still on the hook to pay them that $7,000. So that's the life-only option with the immediate annuity, and that's a very basic option. It's not really used that much anymore, especially in today's times, because a lot of people like to leave money to their beneficiaries. They like to leave some sort of inheritance, and they do not like the fact that they surrender all their money, that they're essentially surrendering their $100,000 or their $1,000,000 to the insurance company, and then they could never dip back into that money. They basically surrender that money for an insurance contract, for basically an income contract. Now, the other aspect is you could utilize something known as a joint life income. So, same thing. Let's say if you have two individuals. Let's say you have a male age 65 and a female age 63, and they both have $1,000,000 in cash. Let's say they sold a business, and they say, okay, we want income to come to us for the rest of our lives. Well, typically what they do is when you have the male and you have the female, they could have a joint income option through a single premium immediate annuity, but it will go off of the youngest of the two. So let's say we have the male age, 65, or the female age 63. It's going to go off of the youngest age, and that's how the insurance company determines that calculation. So if you have $1 million, maybe with a single with the male age 65, for the $1 million, maybe the insurance company would pay this person $75,000 every year. Now, because we have two lives, the insurance company now has a larger risk because, on mortality rate speaking, it's going to take a longer time horizon for a married couple or for the second person to pass away than obviously all the risks just going to that one individual. So the insurance company can offer a higher payout if you're just utilizing the single life only option as opposed to the joint life only option. And let's say the joint life only option, now this will pay $60,000. So this person is essentially losing $15,000 of benefit, of income benefit per year. And this is what and kind of the best way that you can think about this is how a pension plan is paid out. For anybody that was, worked for a company that was lucky enough to be offered a pension option, you might have option A that will pay that single life only option, or option B that will pay the joint life only option. Option A might be $5,000 per month of income for life. Option B might be $3,000 per month for income for life. It's the same thing, is because the company is going to give less of a benefit because now they're covering two lives as opposed to one life. But once again, if this couple had children, they understand that, yes, okay, they have their $60,000 that they can never outlive, for the rest of their life, but now they don't have any inheritance. Let's say, God forbid, both of them pass away in an accident, or one passes away, the other passes away shortly after, and let's say they've only gotten paid out that $60,000 for 10 years. Well, that's 600 grand that they would have got paid out through the insurance company. But let's say after the second person passes away, in that scenario, the insurance company now walks away with a $400,000 profit. So a lot of insurance companies, they will constantly offer you these types of plans, and they're constantly going to say, oh yeah, you know what, annuitize your money, or yeah, go into the single life only option, the joint life only option, because they want you to surrender that control. When you're surrendering that, when you're executing those income riders, you are essentially surrendering control with that single premium immediate annuity. Now, there are times that you could really leverage insurance-based contracts with this type of option, where let's say you have the male that's age 70, that's would be able to receive $75,000 per year, and let's say this person is really healthy. Well, you could do something like taking the $1 million, receiving $75,000 per year, and then maybe taking $7,000 out of that 75 grand to now purchase a $500,000 death benefit, tax-free death benefit plan for life insurance. So what you could do is basically leverage your chips, say, okay, well, rather than go with option B that would only pay us $6,000 per year, we could go with option A, but out of that $75,000, we'll take out $7 grand to pay for a $500,000 death benefit, $500,000 life insurance policy for that male age 65. So what you're doing on this scenario is you'd be netting about $8,000 more income dollars every single year for both the husband and wife to live off of. Let's say if that husband passes away, well, now the wife, it's not as if they lost all that money. It's now the wife would receive $500,000. Or let's say if the wife passed away before the male, then obviously the male will now have an increase of that income, can still be paying for that life insurance, and then that life insurance will now go tax-free, to the beneficiaries. So there's so many different nuances on how you could set up an immediate annuity properly. Now, just like anything, there's been so many advances with annuities. You have so many different types of new annuities out there, ones that go against what traditional mindsets are about the bad things regarding annuities. What do I mean by that? Well, you have annuities now where you could still maintain control of your physical dollars, but have that income stream, have that lifetime income stream payout that would still come to you, and that's through the form of income riders. So a lot of times when you have an old school thought of somebody that experienced annuity in the 1980s or the 1990s, they're thinking primarily of this immediate annuity concept. Or if you have somebody that's taking their insurance exam, they're going to see annuities through only the immediate annuity, the most cut, dry, vanilla type products. So, immediate annuities could be used very, very well for a specific situation. Me in particular, I use immediate annuities through laddering strategies. So, like, I would only use not so much the single life income option or the joint life income option. I set up these plans with if you have like a 5-year payout, or you have a 7-year payout, or you have a 10-year payout. So what I do is if somebody comes to someone calls in, or I'm dealing with them face to face, whatever that case may be, and they have a lump sum of money, I'm trying to look for different ways to leverage their assets the best way possible. So if we have one product that works really good after a 5-year deferral, and then it executes lifetime income after 5 years, but before that 5 years, this product is not attractive, you can use a portion of dollars into an immediate annuity that would give you a 5-year payout, a 5-year fixed payout. So you're at least executing that portion of dollars into that immediate annuity, having that income get paid out for those 5 years. As that 5 years expires, that person runs out of all that money off of that immediate annuity stream. But now leg two is the secondary product will now kick in, and that secondary product will give the individual things such as account value, access to their account value, access to a really good income stream, a lifetime income stream. And there's so many different ways to really leverage your chips properly and make sure that you're getting from point A to point B successfully. I guess with my closing remarks, what I would recommend is to really look at some of the other videos, or give our 1-800 number a call. It's 1-800-566-1002. And reason being is you do not ever want to be positioned into a one-size-fits-all product, and especially with immediate annuities. If you get set up in this and you do not know properly what an immediate annuity did, and realize that you now just surrendered your money, that's a huge problem. With retirement, you don't have any chance to make mistakes. You have to make sure that you get it right the first time, because there's no second chances. If you go and you leverage your retirement dollars into too much of a risky product and the market crashes, well, now you lose your money. If you go and leverage too many dollars into an immediate annuity, and then you come into some sort of oh my gosh moment where you need to have a lump sum of cash, well, you just surrendered your dollars. You unfortunately made that mistake. So just understand that annuities, they have had so many advances, especially in the past 5 to 8 years, regarding the amount of control that you could receive, regarding the amount of benefits that could be provided, to certain cash accounts or retirement accounts. So that's why I talk about annuities a lot of times, but I want to really break down for you what is the proper annuity. So, at any point in time, please give our 1-800 number a call. Once again, like I said, it is 1-800-566-1002. We are A+ rated on the Better Business Bureau. We've never had any complaints. We've always had very good reviews, and it's because of our methodical process. I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. And please watch all the parts and all the different sections of our Annuities for Dummies videos. The whole reason why I'm kind of doing this is I understand the amount of national volume I'm getting from one of my videos entitled Annuities for Dummies. It's more generalized, so I just want to be very specific with all the types of annuity contracts. So thank you so much, guys, and I hope that you really enjoyed this video. Take care.